In corporate finance, few topics hold as much weight as capital structure and shareholder distributions. These pillars influence a company's cost of capital and market value. Capital structure is the blueprint of a company's financing. It outlines the mix of debt, preferred stock, and common equity. A well-structured capital structure provides stability. Shareholder distributions are the return on investment for equity holders. This includes cash dividends, stock dividends, and stock repurchases. Effective distribution strategy influences shareholder satisfaction and company value. Our journey begins with a deep dive into capital structure. We'll examine debt, preferred stock, and common equity. Next, we focus on risk, differentiating business and financial risk. We'll explore shareholder distributions like dividends and buybacks. Finally, we'll uncover theories like trade-off and pecking order. Join us to navigate corporate finance and make informed decisions. At the heart of a company's financial framework lies its capital structure, a term that encapsulates the composition of its funding sources. It's about the sources of that money and the delicate balance between them. Imagine a company's capital structure as a pie chart divided into slices representing different sources of funds. The most fundamental distinction lies between debt and equity financing. Debt involves borrowing money from creditors with the promise of repayment with interest. Equity represents ownership in the company. Common stock grants shareholders voting rights and a claim on the company's residual profits. Nestled between debt and common equity lies preferred stock, a hybrid form of financing. The concept of an optimal capital structure underscores a fundamental challenge in corporate finance, finding the perfect blend of debt and equity that minimizes the cost of capital while maximizing firm value. This optimal point, however, is not static. It's a moving target influenced by a myriad of factors, both internal and external. A company's industry plays a crucial role. Stable, predictable industries with tangible assets often favor higher debt levels, leveraging predictable cash flows to cover interest payments. Conversely, companies in volatile, high-growth sectors might shy away from excessive debt, opting for a more equity-heavy structure that provides flexibility and reduces the risk of financial distress. A company's life cycle stage is another critical consideration. Young, rapidly growing firms often lean towards equity financing as their need for flexibility outweighs the potential benefits of debt tax shields. Mature companies, on the other hand, with established market positions and predictable cash flows, might find it advantageous to take on more debt, utilizing tax advantages and potentially enhancing returns to equity holders. The quest for an optimal capital structure is an ongoing process, a continuous balancing act, influenced by a dynamic interplay of market conditions, company-specific factors, and investor expectations. It's not about finding a one-size-fits-all solution. It's about adapting, adjusting, and making strategic decisions that align with the company's long-term goals and maximize its value creation potential. In business, risk shapes decisions and influences outcomes. Risk presents opportunities, crucial for informed financial choices. Two fundamental types of risk: business risk and financial risk. Business risk stems from uncertainties in operations. It's the risk in day-to-day activities, regardless of financing. Financial risk is tied to a company's use of debt. Debt introduces an obligation to make fixed interest payments. This amplifies earnings fluctuations, increasing financial risk. Balancing these risks is essential for effective capital structure. Business risk is the heartbeat of uncertainty every company faces, an unavoidable consequence of operating in a dynamic market. It's influenced by a complex web of internal and external factors. Competition drives business risk, eroding profit margins and forcing risky investments. Demand variability adds another layer of complexity. Seasonal trends and economic cycles impact revenue streams. Managing business risk is an ongoing balancing act. The goal is to understand, assess, and mitigate risk effectively. Debt financing is a calculated gamble, a double-edged sword for growth and returns, but also for amplified losses. The higher the debt-to-equity ratio, the greater the financial risk. Fixed debt obligations magnify changes in operating income, impacting profitability. In tough times, fixed interest expenses can lead to losses and even bankruptcy. Managing financial risk is crucial for long-term sustainability and shareholder value. Balancing act between tax shields and financial distress. The trade-off theory is key in capital structure. Balancing debt and equity. Debt offers tax benefits, reducing taxable income. But debt also brings financial distress risks. Companies must balance tax advantages with distress risks to find their optimal capital structure. Section 2. Pecking order theory. The hierarchy of financing choices. The pecking order theory delves into how companies raise capital, suggesting a clear hierarchy in their financing preferences. Companies prioritize internal financing first, using retained earnings or excess cash. If internal funds are insufficient, they turn to debt financing. Issuing new equity is the last resort due to potential negative signaling effects. Modigliani-Miller. Irrelevance. Theory. A world without frictions. The Modigliani-Miller irrelevance theory posits that in a perfect world, a company's capital structure is irrelevant. Proposed by Franco Modigliani and Merton Miller in 1958, it challenged conventional wisdom. The theory assumes a perfect market with no taxes, bankruptcy costs, or information asymmetry. In such a market, a company's value is determined by its assets, not its financing. Two identical companies, one with equity and one with debt, would have the same market value. Investors would see no advantage in one capital structure over the other. They could replicate any structure through personal borrowing or lending. While rarely met in reality, the theory remains a crucial benchmark in finance. Let's explore shareholder distributions, a critical aspect of corporate finance. These distributions are tangible rewards for equity holders, reflecting their stake in the company's success. They manifest a company's commitment to sharing profits and enhancing shareholder value. The most common form is cash dividends, providing a steady income stream. Another form is stock dividends, issuing additional shares to shareholders. These don't change overall value, but can make stock more accessible. Shareholder distribution decisions are strategic choices that impact a company's market value and investor relationships. How a company returns value to shareholders influences investor perceptions and shapes investment decisions. Consistent and growing dividends signal financial strength and confidence in future earnings. Positive perceptions can boost demand for the company's stock, increasing market value. Cutting dividends might signal financial distress, leading to a decline in investor confidence and market value. The decision of how much profit to distribute to shareholders and how much to retain for reinvestment is a constant dilemma for companies. Dividend policy, the set of guidelines a company uses to make these decisions, is a subject of much debate in the financial world. Miliati and Miller's dividend irrelevance theory posits that in a perfect market, dividend policy is inconsequential. However, the real world is far from perfect. Taxes play a significant role in shaping investor preferences. The tax preference theory argues that investors favor capital gains over dividends due to tax advantages. The bird in the hand theory suggests that investors prefer the certainty of dividends over potential future capital gains. Delving deeper into dividend strategies. The signaling hypothesis suggests companies use dividend changes to signal future prospects. A dividend increase is seen as a positive signal, while a cut suggests financial difficulties. The clientele effect recognizes different investor preferences for dividends. Retirees prefer stable dividends, while younger investors might favor growth. The residual dividend model suggests paying dividends from residual earnings after funding investments. Companies must navigate these theories to align with their financial goals and enhance shareholder value. Beyond cash dividends, companies have tools to reward investors and enhance shareholder value. Stock dividends and stock splits offer ways to distribute value without impacting cash flow. These methods can significantly affect a company's stock price and market perception. A stock dividend distributes additional shares to existing shareholders. It's like slicing a pie into smaller pieces. The overall size remains the same. A 10% stock dividend grants 1 new share for every 10 owned. This impacts the stock price, but not the company's value. Stock splits increase the number of shares by splitting existing ones. A 2-for-1 split doubles the shares, halving the price per share. These actions enhance liquidity and attract a wider investor base. Lower stock prices make shares more accessible to retail investors. Unlike stock dividends and stock splits, stock repurchases or buybacks offer companies a strategic tool to influence their capital structure and signal market undervaluation. In a stock repurchase, a company uses its cash reserves to buy back shares, reducing the number of outstanding shares. This can boost investor confidence and potentially increase the stock price. Stock repurchases also offer a flexible way to manage capital structure, especially with excess cash flow. Despite criticisms, they remain a powerful tool to manage capital and enhance shareholder returns. Capital structure and shareholder distributions are the lifeblood of a company's financial health. They influence risk, cost of capital, investor attraction, and long-term success. A sturdy capital structure provides financial stability. It's about balancing debt and equity, leveraging tax advantages, and mitigating risks. Shareholder distributions reward equity holders and impact market value. These decisions affect investor relations and capital retention. The journey through the world of capital structure and shareholder distributions is not a one-time event. It's an ongoing process of adaptation, adjustment, and strategic decision-making. The financial landscape is constantly evolving, shaped by macroeconomic trends, regulatory changes, technological advancements, and shifting investor preferences. Companies that thrive in this dynamic environment are those that embrace flexibility, constantly reassessing their capital structure and distribution policies to ensure they remain aligned with their long-term goals. This requires a deep understanding of the interplay between risk and return, the ability to anticipate market shifts, and the agility to adjust course when necessary. By viewing capital structure and shareholder distributions not as static concepts, but as dynamic tools for value creation, companies can position themselves for sustainable growth, attract and retain investors, and ultimately achieve their full potential in the ever-evolving world of finance. The journey might be complex, but the rewards of financial mastery are well worth the effort. As you continue your exploration of the financial world, remember that the pursuit of knowledge is an ongoing endeavor. Embrace the complexities, challenge conventional wisdom, and never stop seeking a deeper understanding of the forces that shape the financial landscape. The more you learn, the better equipped you'll be to navigate the challenges and seize the opportunities that lie ahead.